I'm Phil Rosen. I'm the Chief Market Strategist for ProCap Financial. You're watching Taking Stock.
Turn around. Stand by. Time to rock and roll on this Thursday, May 28th. It's already the end of May somehow. 2 minutes to go here into the closing bell. A fresh round of all-time highs. Peter Tuchman, this is now becoming a regular thing. You joined me here for the start of the broadcast.
Sell in May and go away.
What happened?
And no, forget it. That hasn't worked for years.
That is the old adage, but what happened specifically in this month of May? And there's no shortage of things for investors perhaps to be concerned about, shaking them off to another round of highs.
There's no question. There's plenty to be concerned about. But they're shaking off the PTSD from last year, February, March, and April. They were not going to get caught behind the eight ball on this. People decided to engage earnings, guidance, and more the core of the market as opposed to all the chatter about the conflict in the Middle East. And they decided to buy the market, and that's what my feeling is. Also, the AI story is on track to do everything it's promised to do, right? And that is secondary, tertiary story around power, the grid, and all that kind of stuff around the AI story, building data centers. It's on track. Our man Dan Ives, I interviewed him yesterday, and he said that he just came back from a trip. Everything is on track. Though things are, the CapEx expenditure is astronomical. The demand is there, and we're going to the moon. That's the bottom line.
I'm glad you mentioned our mutual friend Dan Ives at Woodbush. He said for quite some time, we're only in the second inning of this AI
now in the third
build-out.
inning.
Now we're in the third.
Yesterday, we're in the third inning.
A little bit deeper.
One out. Plenty of room left to play.
Still plenty early. Einstein of Wall Street kicking us off. The team from Churchill set here to do the honors. More Taking Stock after the closing bell. All right, and there you have it for a fresh round of all-time highs down here on the trading floor of the New York Stock Exchange. A more proper welcome to the broadcast, one and all. You're watching Taking Stock. I'm your host today, J.D. Durkin. A fresh round of all-time highs for the Dow, for the small caps, for the NASDAQ, the S&P 500. You name the major index of choice, it probably closed at a new record high. Your final tail of the tape, the S&P 500 up 0.6, the Dow up fractionally, the New York Stock Exchange Composite Index up, let's call it 1/10. The small caps in on the action, up 0.6 as well. Healthcare, tech, consumer discretionary, those lead the S&P 500. Over in the Dow, outperformance from IBM, Microsoft, Nike, Boeing, as well as Goldman Sachs. How about this? Goldman Sachs closing above $1,000 a share for the first time ever. It's also the only Dow stock that now costs $1,000 a share. It's been public since 1999. Goldman Sachs has never had a stock split. Do with that information whatever you will. Over in the Mag 7, 7 for 7, green across the tape. Microsoft up about 3.5%. Looks like Amazon up about 0.8. Comparable story for Nvidia as well. Einstein and I just talking there a few minutes ago about today's PCE inflation print. For more perspective on today's tape, as well as the inflation print, let's bring in the man himself, Michael Reinking, Senior Market Strategist down here at the big board. Wow, we got a lot going on, man.
Yeah, we got markets moving higher. You know, everybody's happy, smiles on the faces of everybody in New York City, especially with the Knicks in the finals.
Dude, a little Jalen Brunson bump here for the major market indexes. What's going on with PCE? Because I feel like there's something in this for everyone. If you're more concerned about pricing pressures, maybe look at that core number going up to 3.3. Headline maybe could be worse. What'd you make of it?
Yeah, look, I think the numbers came in a little slightly better than feared, right? But we did see an acceleration, kind of on the annual readings. The bigger story right now is that we all kind of know the Federal Reserve is on hold, right? At least for the time being. As we're going to see some of those inflationary pressures, start to build, continue to build in the coming months. However, right, with what's going on, with the discussions around diplomatic resolutions in Iran, right, that can take kind of some of those, that like a move lower in oil prices will definitely take kind of the inflationary pressures out of this market, right? So you saw yields pull back a little bit today, right? And that's why we've continued to see just kind of a broadening of this route.
I mean, it's interesting. As we've seen equities reach all-time highs, for the most part, West Texas Intermediate and Brent crude, those are our two big oil benchmarks. We got big pops up, we get big pops down, but for the most part, since the start of the conflict, we've been relatively range bound. They hasn't really broken up much above 105, hasn't really broken down maybe below, where's it at now? 90, 95?
Yeah, so I think actually from a technical perspective, right, we have seen a little bit of a break here in ICE Brent, right? So it's sort of interesting.
Nice.
To start this week, right, we broke below the 50-day moving average, right, for the first time since the conflict, right, and we haven't been able to reclaim that kind of throughout this week. Now this morning, right, we did kind of break below yesterday's lows. We're at around $93 on ICE Brent. The 100-day moving average and then the February and kind of April lows are right around 85, or around 83 to 85. So we have about 10% of potential downside here if we start to get a better sense that this 60-day kind of proposal or ceasefire proposal is going to hold.
I want to get your take on how much of this ongoing rally is led specifically by tech and AI names. I mean, it's not every day. We take a look. Healthcare was the big winner on the day. We don't get to say that very often, but overall, what are you seeing out of the generals leading the pack?
Yeah, look, so I mean, interestingly enough, within healthcare, it was the mega cap name within that sector, Eli Lilly, up over 3% as they got approval from the PBMs for their kind of weight loss drugs. Yeah, but we also saw, which is the real big key in this market, is kind of earnings, right? And we had some very strong earnings within healthcare today as well. Agilent, going to put up strong numbers. The stock was up over 15%, right? Which helped the life science companies kind of within that sector. And that's been a really kind of an underperforming sector. Tech has clearly been kind of the standout here, as we've continued to see kind of that move from, kind of the semiconductor names to other areas, kind of like memory, where you see supply shortages. But now today's strength really came from in the way of software, which has been a big underperformer as well. Right, and we saw kind of those software stocks, kind of leading to the upside. The IGV was up at least 3% the last I looked at.
Yeah, I mean, Snowflake shares up almost 4. I wrote in my notes a couple hours ago, up 30%. I came in here to work an hour ago. I was like, no, more like 38. We're going to talk more about Snowflake shares in just a bit. My man, thank you for being here as always. It's awesome to kick off the show with you. Very grateful for your time.
Absolutely, thanks for having me.
Take good care, Robbie. Grab your mic. Let's go, Knicks. Jalen Brunson and them Knicks. All right, let's head this way. Top analyst calls on the day you may have missed this morning here on Wall Street. First up, Deutsche Bank reiterating Marvell as a buy, lifting the price target to 240 from 120 following earnings. Shares up 130% year to date. Hello. Next up, JP Morgan upgrading Dick's Sporting Goods to overweight after earnings. They say the retailer stands to benefit from America 250, the FIFA World Cup, the 2028 Olympics, maybe a Jalen Brunson bump for Knicks fans here in New York as well. Finally, Morgan Stanley reiterating Tesla as equal weight on expanding robo-taxi operations. Shares down 4% so far here in 2026. Bobby, we'll take a look at two stocks that call the New York Stock Exchange home. These are not typos on your screen. Bobby, take a look at Snowflake here. That does say the stock finished up more than 36% on the day after announcing its cloud division will invest $6 billion into Amazon AWS over the next 5 years. Snowflake reporting a beat on top and bottom lines. Bobby, let's swing on this way. We'll take a look at BBY. This is Best Buy up almost 16% after better than expected earnings, reaffirming its full year guidance, also saying its biggest growth drivers include gaming, computing, and mobile phones for the first quarter of the year, now up more than 30% over the last 7 trading sessions here on Wall Street alone. Earlier today on this Thursday morning, FinTech TV lead anchor Remy Blair sat down one-on-one with David Lawant of Anchorage Digital. They discussed SpaceX's Bitcoin holdings, the state of 401ks, and much more. Take a look.
Joining us this morning to discuss how these factors will directly impact liquidity as well as price action and even 401k adoption is David Lawant, who's the head of research for Anchorage Digital. David, good morning. Thank you so much for joining us. So first and foremost, I do want to start out with the upcoming mega IPOs. And you've noted that public offerings from these names, such as SpaceX, OpenAI, Anthropic, could be a major factor for digital assets. So break this down for us.
Hey Remy, thanks for having me. Excited to be here. Yeah, for sure. As you well noted, the Bitcoin space, especially let's say the crypto majors, they have been failing a little bit to follow suit with the market rally that we saw over the past 6 to 9 months. And there's a bunch of reasons for that. Some are more structural, but others are more narrative. And I would say that, I mean, the fact that we have all these hot IPOs and these themes, maybe AI related, this is sucking a lot of air and capital out of the room. For Bitcoin specifically, what that means is that it's having a lot of trouble to cross the 80K level barrier. Whenever Bitcoin gets closer to this 80K level, the amount of sell pressure that we see on the order books is very clear in the data, gets pretty heavy. So this has been a hard ceiling for Bitcoin to break. Going forward, let's see how things change, but I think it's going to be a big battle at the top of this 60K to 80K price range, which is where Bitcoin has been trading for a good while now.
Yeah, and 2026 has been quite the year when it comes to volatility, especially given the geopolitical situation in the Middle East. And we have been looking at digital assets as well as other asset classes over the weekend when the traditional markets are closed. But if, as you said, everyone who wanted to sell Bitcoin already sold by April, when do you expect this historical volatility to actually return here?
Yeah, this is a great question, and I think the big driver here is probably going to be macro induced. You covered this well in the previous segment, but there's this big chain of events, right? The Iranian conflict, which is impacting oil prices, which is putting pressure in inflation and inflation expectations here in the U.S., and therefore putting a dent on interest rate cuts, right? Just a few months ago, the market was pricing multiple interest rate cuts throughout 2026. Now the CME Fed Fund futures are pricing a 50% chance that we're actually going to see an interest rate hike in 2026. So I think whenever the macro environment here becomes a little clearer, I think this is going to be a major driver for a lot of these risk-on assets, and I think Bitcoin plays at a pretty end of the spectrum here. There are other important industry developments as well. So, for example, we are on the verge of potentially seeing the crypto market structure bill getting approved over the next 2 to 3 months. Let's see the tough battle here. Most folks are attributing a 50% chance of it getting passed, but there's also some interesting industry drivers. Overall, I think the important thing to keep in mind is that the fundamental investment case for Bitcoin, I think, remains still very solid. Governments continue to overspend. This idea of a non-sovereign store of value today is way more accepted than it used to be. You can see that by the caliber of institutions that are engaging with Bitcoin and crypto more broadly, names like BlackRock and Morgan Stanley. So thinking about the longer term here, I think Bitcoin continues to have a very bright future. In the very short term, though, I think we're going to be dependent on what happens on the macro. This is probably going to be driving the bus for us.
Well, David, we will have to leave it there for today, but thank you so much for joining us today, and thank you so much for sharing all of your insights.
Welcome back to the broadcast. You are watching this Thursday afternoon edition of Taking Stock live from the trading floor of the Big Board. Join us now. Varun Modgil is the founder and CEO of Sokin. Very grateful for your time, my man. Nice to see you.
Appreciate being here, JD.
You help businesses move money globally faster and cheaper.
Yeah.
Talk to me about how you do it and who do you do it for?
So we help businesses scale without friction. And what that basically means is across 3 product verticals. So we provide bank accounts, stablecoin wallets, we provide treasury management solutions and payment acceptance. And what we do is we have 2 direct verticals that we sell this down. So direct and embedded. Enterprise, mid-tier, and also payroll techs, fintechs, every solution touching every point of every business from SMB to enterprise.
There's no doubt to me, finance chiefs, CFOs especially, they're under immense pressure to manage liquidity. What do they actually want that they are currently not getting?
Too many vendors, too many platforms, too many banking partners, too many integrations. Sokin comes in, one platform, you can scale up, you can go to Asia, you can go to South America. We provide the platform for them to be able to scale up very quickly. And this is what we're seeing with every CFO treasury platform at the moment. There's just too much going on and there's too much complexity, and we make it simple.
There's no doubt the moment for stable coins is here. We are increasingly talking about stable coins more and more here on the show, understandably so. For people a bit unfamiliar, how do they actually better facilitate cross-border payments?
Look, 24/7 settlement, no waiting on Friday 5 p.m. to make your payments and receiving on a Monday, liquidity being available to you constantly. It's an upgrade, right? So it's like trucks to planes. Same package, same destination, just faster, and that's what CFOs want.
Talk to me about your partnership and how do I pronounce it here? Adyen?
Adyen, yeah.
Adyen.
Yeah.
What is it? What does it unlock for your customer base?
Sokin's global accounts and treasury accounts matched up with Adyen's global network of acquiring. It's a match made in heaven, and that's the product that we're delivering to all of our customers, and stems to what I just said before. Scaling down those platforms, those integrations, making it easier for all of our customers to scale up very quickly. And now you can accept payments, you can hold payments, you can make payments all from one place, and that's why we're doing so well.
How do relationships like that come about? Because the rest of us on the outside, we see the headlines, you're partnering with Adyen, it sounds great. We have no idea what actually goes into curating those relationships. I got to imagine you're very specific about the partners you're willing to work with.
Yeah, likewise, and we got selected by them, so it's testament to the company and the scale that we're reaching at now. We're doing like over 10 billion in sort of ARR in transactional volume, so the business is successful now, and it takes long for those partnerships to get to fruition, and everyone sees the headline, but no one sees the work behind it.
Yeah, correct. FinTech has gone through, of course, a major reset over the last few years. How did you manage to have multiple revenue 8x since 2022? That's impressive growth.
Yeah, 110% year-on-year growth. We're profitable. We're doing 100 million in ARR. We'll probably do 150 by the end of the year. And there's a lot of things that goes into that. We're customer obsessed as a company. So we're not competitor obsessed. So every product that we release, we know there's going to be usage on the platform. Number 2, licensing, regulatory modes. We're operating in over 40 countries within our licenses, allows us to do a lot of things. And thirdly, an investor base. We've got great Morgan Stanley, Prism. They push us to do agentic treasury, innovation, and they're constantly pushing us forward. And that's great to have those partners, and that's why we're doing so well.
Dude, I feel like it's difficult enough to manage the regulatory hurdles of the United States. How do you do it for dozens of countries, each with their own rules of the road?
The great team at Sokin, from sales to compliance to operations, everyone's contributing to the success of the business.
I'm almost out of time. Before we let you go, what is the biggest misconception people still have about global payments and modern fintech?
That it takes time. You rely on Swift. You've got an option now with Sokin, Swift, stable, fiat, everything. We can do it all in one.
Varun Modgill, founder and CEO of Sokin. My man, congratulations on all the success.
Thank you so much.
Nice to have you.
Thank
Don't
you
go
for
anywhere. A whole lot more Taking Stock coming up right after this. That's really good. Welcome back to the broadcast. Time now for what is always my favorite part of the show, not just speaking with an amazing guest, but how about the team that just rang the closing bell here at the New York Stock Exchange. The president and CEO of Churchill Asset Management, Ken Kencel, joins us now. It's great to see you here, sir.
Great to see you, JD.
Talk to me first and foremost, what was the experience like for you and your team down here, and what brings you down here to ring the closing bell?
It was absolutely fantastic. I must say, every time I'm on the floor, the energy and the enthusiasm of folks here at the exchange is always incredible, and it was incredible again to do that today. What brought us here? Our 20th anniversary for Churchill. So 20 years of investing in private credit and super excited to be here and to mark such an incredible milestone.
For anyone, even potential kind of would-be clients who are a bit unfamiliar, what are some of the core values of your operation that have sustained the business over these last 2 decades?
Absolutely. Investment in our people, partnership with our clients, commitment to long-term values have been a part of who we are from the beginning. Could not be prouder of our people, the relationships we've built over a 20-year history, and the commitment to fundamental values. So we've started out 20 years ago with a commitment to private credit, core middle market private credit, and we're still there today doing exactly what we did 20 years ago. So very proud of that.
What conviction about that space do you hold even more strongly today, I wonder, Ken Kencel, than you did 20 years ago?
I would say the performance of private credit in the core middle market, the fact that it remains an incredibly strong risk-adjusted return for our institutional investors all over the world. We have over 5,000 institutional investors all over the world, and we've delivered consistent return over a very long period of time. So the quality of the underlying investments, the ongoing current yield that it provides, and the quality of the underlying businesses is really critical to us, and it's been that way for a long time. Through the GFC, through COVID, through higher interest rates, and here we are today, 20 years later.
And fresh rounds of all-time highs as well for all those long holders of institutional investors. I wonder, what does the smart money ask you? I wonder, are there particular parts of the market or your relationship with them as clients they want to learn more about?
Sure. Well, the first question we get today is private credit now, very hot topic, right?
Sure.
For a long time we were operating and we were kind of the quiet world nobody wanted to talk about. Suddenly private credit became everybody's focus. And so what we hear all the time is talk to us about performance. Talk to us about how your portfolio is doing. What are your underlying default rates, loss rates, et cetera? And the easy answer and very straightforward one is performance has remained incredibly strong. They also ask us a lot now about the retail dynamics, right? Private credit in the retail market, redemptions, those questions. Fortunately for us, we are 96% institutional. We have had limited redemptions in our overall public vehicles, so in that sense, we kind of check all the boxes, if you will. And I'd say the last thing is, what does the environment look like today for investment? What are terms like? What are spreads like? What are underlying credit quality like for new deals that you're doing today? The short answer is absolutely fantastic. I'd say the best opportunities we've seen in probably the last couple of years.
I got about a minute left. I know there's a lot of interest from retail investors in the so-called shiny thing.
Yeah.
Do you ever get institutional, the smart money guys coming to you and saying, hey, what's the deal with SanDisk or silver or these other things going parabolic? And what do you tell them about maybe avoiding the new shiny thing of the day?
Well, I like to say that in many respects, we were the tortoise versus the hare in our business. And the good part about private credit, or the important part about private credit is, for those of us who've been doing it a long time and do it well, is it's boring, okay? It's, being boring is not a bad thing.
Correct.
It's consistent, it's stable, delivers good long-term returns. So it may not be the most shiny thing, but it delivers long-term returns to participants, for investors, for our parent company, TIAA. We manage capital for them. They've been an important part of the success along with Nuveen, so I want to just sound out a thank you for them and for all the success we've had. Very grateful.
Boring is good when it comes to long-term investing.
Exactly.
In the financial markets. Don't forget, Ken Kencel taught you that, President and CEO of Churchill Asset Management. What a pleasure. Congratulations, Ken. Nice to see you.
Thanks very much, JD.
Don't go anywhere. A lot more Taking Stock coming up right after this. Awesome. Welcome back to the show. At this hour, the latest headlines in the world of fintech, crypto, and AI you need for your Thursday afternoon. First up, the crypto majors are in negative territory at this hour. Bitcoin hovering around 73,500. Next up, President Trump saying he will, quote, never let crypto down, promising a future-proof regulatory framework as his White House pushes to make the U.S. the global capital of digital assets. And finally, the White House is reviewing a new CFTC proposal to regulate prediction markets as a growing battle emerges over whether federal or state governments should control the overall industry. And now Money 2020's very own Scarlett Sieber is back to explain the ways fintech companies really make money. Take a look.
I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money, where we look past consumer brands and talk about the infrastructure that actually moves that money. Today we're going to be talking about Thunes. If you spent any time walking the halls at Money 2020, I'm sure the name will sound familiar, because Thunes sits right underneath a huge amount of global payments ecosystem. You may not see Thunes in an app store, you won't tap it on your phone, but when money moves across borders, especially into hard-to-reach markets, there's a very good chance Thunes is involved. Thunes operates global cross-border payment infrastructure that connects banks, wallets, and payment providers all over the world. Its core asset is its direct global network, spanning more than 130 countries, supporting 80-plus currencies, and integrating directly with hundreds of local endpoints. So how does Thunes actually make money? First, transaction-based fees. Every time money moves across the Thunes network, the company earns a fee. On a single transaction, that's quite small, but at global scale, it compounds quickly. Second, network access economics. Payment providers pay to connect into Thunes network, and once they're connected, switching away is incredibly painful. That creates long-term recurring economics. Third, volume leverage. As Thunes add more corridors and more endpoints, the network becomes more valuable. More usage drives margin expansion. This is classic infrastructure math. What makes Thunes particularly interesting is where it operates. Cross-border payments are fragmented, regulated, and extremely hard to execute well, especially in emerging markets. That complexity is a feature, not a bug. It creates defensibility for platforms that get it right. So why is Thunes especially relevant right now? Because cross-border payments are exploding, driven by global commerce, remittances, digital wallets, and the gig economy payouts. All at the same time, regulators are demanding better compliance, traceability, and speed. That backdrop shows up clearly in the numbers. In April 25, Thunes raised 150 million in the Series D, the largest round in its history. At the time of the raise, the company was already profitable and operating at roughly 150 million in annual revenue, a combination that's still rare in fintech at this scale. That wasn't capital raised to discover a business model, it was capital raised to accelerate one that already works. So what's the moat exactly? Network effects and regulatory complexity. Building a global payments network isn't just about software, it's about licenses, compliance, local integrations, and trust, stacked on top of each other over years. Once that infrastructure is in place, it's extremely hard for competitors to replace quickly. Thunes doesn't need to win consumers, it needs to win other fintechs. And that, my friends, is how Thunes actually makes money. By owning the invisible rails that global payments depend on every single day. Not flashy, not consumer-facing, but exactly where durable fintech businesses tend to live. If there's a fintech company you want to hear about, drop them in the comments. We may just make them on the news. We'll see. In the meantime, back over to you.
Welcome back to the show on this historic day down here on the trading floor of the New York Stock Exchange. I forgot where we were for a second. Fresh all-time highs for the S&P, the small caps, the NASDAQ, as well as the Dow, IBM, Microsoft, Nike leading the Dow, while your laggards, Caterpillar, Travelers, and Sherwin-Williams. That's going to do it for today's edition of Taking Stock. Thanks for watching. Have a great Thursday night. We'll see you again tomorrow.